another accounting standard, and that is IAS 37, provisions, contingent liabilities, and contingent assets. So stay with me carefully. You know provisions already, not provisions like what you give to your free SHS people when they are going to school. And you know what the heck liability is. What is the difference? Liability is a present obligation. You know that already. Okay. A present obligation as a result of past events. Provision, on the other hand, is a liability of uncertain amount and timing. Meaning we owe, but we don't know how much we owe and when we're going to pay. That is why it's called provisions. So at what point can we recognize provisions? So recognition criteria. It's simple. Once it is rotten, you provide for it. Sounds good? Once it is rotten, provide for it. Because if it is rotten, it means you ain't going to use it any longer. So you just provide for it. So R represents reliably estimation of the amount. O, there must be a present obligation. And then third is that settlement will result into transfer of future economic benefit. That is the recognition criteria. But you see, the beauty of this whole thing is that it is going to boil down usually on the second one, present obligation. So at what point can we recognize a present obligation and say, hey, let's provide for something? At what point? Present obligation can come from two sources. It could come as a result of a legal or binding agreement. It could come because of a contract that we have signed as an entity, or it could come as a result of terms and conditions attached to a license that the entity has obtained. So let's say that we are a film studio, and so we want to produce our latest series, but then we want it to be a village, and we have scouted the entire country, and there is no existing village that we can really shoot the movie at. But then we have realized that in the Etiwa forest, please, this is just an example, it's not real. It's just an example. We have realized that a place like the Etiwa forest, we could build something there and use it for our movie. So we go to the Forestry Commission and all the people speak with the authorities, national, whatever the heck authority that is responsible for all that. We speak with them and so we were given permission by the Forestry Commission or whatever the heck that they are supposed to give us the license. And they said, okay, listen, they have given us a certain portion of the Etiwa forest that we can build the village we want to build to shoot our series. But then they said that after you shoot your series, meaning maybe it will take 5 years to do the production. After you finish the production, you have to ensure that you demolish the building and landscape the place, grow shrubs, grasses, whatever the heck, trees, so that the forest can come back to where it was when you came. That is a term attached to it. So when we are now building those film studios or those buildings in the Etiwa forest, the cost to be incurred to dismantle or to landscape the place would have to be included in the initial cost of the building. Are you following the picture here? That's what we are talking about in relation to what we said here. The estimated cost of dismantling and removing the asset. That's what we mean. So the present obligation can be legal. It is binding on us. It is because of an agreement, it's because of a contract, or it's part of the terms and conditions attached to a license. Other times, it could just be not legal, but then it could just be due to the policies of the entity that can create that on their website. Maybe the past behavior of the entity, or maybe the expectation that the entity has created can also be a present obligation. So let me give you an example here. Please, like I said, this is an example. So let's say we still want to build the village in the Tiwa forest so we can produce our movie. But for some reason, the Forestry Commission didn't mandate us to replant It's not part of the agreement. But on our website, we have published there that we are an environmentally responsible company. Or in other countries where we did that, after it, we restored the forest. Then it means that although there is no contract, although the Forestry Commission is not binding on us to do it, we will still do it. Why? Because of the policy on our website, because of what we have done in the past, and because of the expectation that we have created. So that now the average Ghanaian will know that, oh, this company in other countries, when they finish building, they restore. When they finish the production, they restore. So that is not contractual. Sorry, that is not legal. It's not binding on the company, but because of the policies, because of the activities of the company, it becomes binding. That is the idea about present obligation. So in a given question, you have to identify, is there a present obligation? That is going to be the starting point. Is there a present obligation? If there is, then we can provide for the provision. Now let's expand on that a little bit. Provisions can generally be divided into two. So we have what we call asset-related provision and then non-asset-related provision. So when you read the question, you must identify, is this an asset-related provision or a non-asset-related provision? Let's break it down. Simple. An asset-related provision is an asset-related provision. That's all. So issues such as dismantling cost, issues such as environmental cost, issues such as landscaping cost are asset-related provisions. Why? Because we are going to incur those costs because of an asset that we have bought, because of an asset that we are using. So for asset-related provisions, we say that the initial measurement shall be included in the initial cost of the asset. What does that mean? Journal entry. So for initial measurement, we're going to debit property, plant, and equipment. That is why we say we include it in the initial cost of the asset. PPE is an asset. So when we say debit it, it means add it to the PPE. Then we credit provisions. Remember, keyword, initial measurement. But there are other provisions that we must also know about, like a court case, okay? Like warranties. Those are non-asset related provisions. So those ones, the initial measurement will be recognized in the profit or loss account. So what will be the journal entry? Debit, profit or loss, and then credit, EBAZE, provisions. So when you read a question and it's about provisions, the first question you need to ask yourself is there an obligation? If there is a present obligation, the next question you need to ask yourself is this an asset-related provision or a non-asset related provision? Because the initial recognition differs if it is an asset related and if it is not asset related. Now, on subsequent measurement, any movement in the provision is recognized in the P&L account. So on subsequent measurement, movement in the provisions shall be recognized in the profit or loss account. Sounds good? It means on subsequent measurement, what we're gonna do, debit profit or loss, whether it is an asset related or non-asset related, or on subsequent measurement, movement goes to P&L account. Understand that the distinction just comes in the initial recognition stage, but on subsequent measurement, the movement is always going to go to the profit or loss account. So we debit profit or loss and still credit provisions. That is what happens on subsequent measurement. If we are using the discounting cash flow method to estimate the provision, then the present value or the initial measurement, which is the present value, will be equal to the cash flow, the expected liability to be paid, multiplied by the discount factor, which will be given to us in the question. And that is what gives you the initial measurement. And so this value is what you either include in the initial cost or put it in the P&L account. So if we are using the discounting cash flow, Then on subsequent measurement, we're going to be dealing with unwinding or calculate the finance cost on it. So the finance cost would then be equal to, which is sometimes called unwinding. So if you hear unwinding somewhere, it's the same as finance cost. That is going to be the initial measurement that we got earlier, or the present value, multiplied by the cost of capital of the company. And this is for, say, the first year. So it is this finance cost that you are taking to the P&L account on the subsequent measurement. Because like I told you, on the subsequent measurement, that unwinding item is generally going to go into the statement of profit or loss. But if you see and look closely, you realize that in initial measurement, irrespective of what is happening, we are crediting provisions. Then on subsequent measurement, we are also crediting provisions. The reason is that you are building up the money so that there will be the money will be available when it becomes due for payment. For that reason, assuming we are using the discounting cash flow method to estimate the amount of provision, then the carrying amount at the reporting date will be equal to that initial value that we got plus the finance cost.
Please, I just wanted to find out, you see the initial measurement, we multiplied it by the discount factor, but subsequently, it's being multiplied by the cost of capital. Are they the same or what?
No, but you did this in KG2. Discount factor is simply going to be 1 divided by 1 plus R exponent n. So I thought you knew this from KG2 because we did this in KG2. When I was in KG2, that's what my teacher taught me. Can you imagine? We did discount factor in KG2. So the R here is the interest or cost of capital, which will be given to you in the question. Then the N is the number of periods. Okay. Sorry, I didn't talk about it, but I thought you knew. So this is how we calculate the discount factor. 1 over 1 plus R exponent N. So the cost of capital is the rate. It will be given to us. The N is number of periods. In other words, how long from now would the liability be due? So if we are going to pay it in 10 years time, then N will be 10. If you're going to pay it in 20 years time, N will be 20 in that order.
Nhyira, please. I knew, but when I saw the cost of capital, you see the subsequent years, I wanted to know, we don't discount. That's what I mean. You know, the subsequent years, it means the subsequent years, we won't do any discounting.
No, the subsequent year, we're just going to be calculating. So that is why I wrote here, say year 1. So in the year 1, we'll calculate our finance cost. Now in year 2, let's say the subsequent year, in year 2, we will still calculate our finance cost, but this time around, it will look like this. The finance cost, not financial cost, the finance cost, or what you would call the unwinding, will be the carrying amount of the provisions from year 1 multiplied by the interest rate. So carrying amount brought forward of the provision for the subsequent year times the interest rates. So in the year 1, it will be the initial cost multiplied by the cost of capital. And if it is less than 1 year, X over 12 will come in. But in the subsequent years, you don't calculate the finance cost on the initial amount again. You now calculate the finance cost on the carrying amount brought forward. Okay, I'm going to explain it to you with a question in a moment, so just stay with me. But that is what you must understand, because in subsequent years, you cannot apply your interest rate on the initial value again. No, it has to be applied on the carrying amount brought forward.